Hello, this is Bill Scheid, and I have the great honor and pleasure to be here with my mentor, Dr. Ken Long, who, in my opinion, is one of the most brilliant minds in the trading and investing world out there today. If you're not familiar with his work, you can find him at tortoisecapital.net. Ken, thanks so much for being here.
Oh, shucks, Bill. Good to be here. Tell me more about me. I always like to hear the sound of somebody else praising me. I appreciate the kind words
Yeah,
very
thank
much.
you. So the topic of this video is the importance of systems evolution, and I think it's perfect that we're doing this together because I started studying with you in 2011, and the very first systems that I learned from you were the first generation monthly systems that you were teaching, BMR and core systems. I've been trading them for decades now and have evolved them over time, and so what we're going to do in this video is just talk about the importance of evolving our systems over time using these monthly systems as an example. And the first system that we are going to take a look at here is the system called BMR21. So this is the second generation system. It's based on the system I learned from you called BMR22. BMR21 just has two evolutions. And the first is that we added a relative strength component to the momentum calculation that we use to select the funds we're going to invest in. And then we slightly change the universe of funds that we evaluate when we're running those calculations. And here in this chart, we're comparing that to the S&P 500 buy and hold in this column, and then a 60/40 stock bond all world diversified buy and hold portfolio. So I'm just interested to hear what you see in these numbers.
Well, in a previous session, we took a look at why you might want to apply a couple simple rules just to the S&P 500, and we saw in that one that you could either reduce your risk by half or increase your gains by 20%, or surprise, get both of those just by applying rules to the market itself in the form of the S&P. Now, the hardest thing in the world to do is to find a system that works in most seasons, except once you have that system, to keep looking beyond it for improvements. It's easy to kind of rest on your laurels. But this one just shows why evolution is really key, because you went beyond just the simple market analysis and started taking a look at reasons to expand your aperture to a wider set of choices. And you can see here the advantage of what you get. You almost double the performance compared to the pure S&P 500 implication at no additional risk to you. So compared to just buy and hold the S&P, you've more than doubled the performance, and you're doing it at one third less risk. And then compared to the 60/40 traditional blend, which is supposed to be a risk adjusted return, uh, this system manages that risk every bit as good, but it gives you uh, better than 6 times the performance. So you don't actually have to make a choice between reward and risk. With a few simple rules and a reasonable selection of targets, you can actually get the best of both worlds. And that's what this one shows to me. So you got to this by evolving and adapting and responding to a market, and continuous improvement, in my view, is one of the great advantages that you have compared to guys that find something and then just forget everything else. And then I think that's what the BMR 21 shows. But I don't think it stops there. I think there might have been some more things coming. What do you think?
Indeed, indeed. And I have to give you credit because you said the phrase path of continual improvement. And that's something that you are always emphasizing in your teachings. And that's something that has made a huge difference. And it actually brings us to the next evolution in the BMR 21 system. And that's when we add the volatility stop called the shot over the bow rule. And credit to you because I heard you say on one of your podcasts that that particular day was a shot over the bow for the market, and so this volatility stop tells us when it may not be ideal to be exposed to equities on the long side. And I wonder if you have any reflections on the numbers that we see here.
Yeah, well, typically volatility is a short-term phenomenon. It's never good for the buy-in holders or for people that want to benefit from the rise. So volatility is an aberration. That's why we worry about it. Because it's emotion-based, it doesn't last all that long. So the periods of volatility are small, but the consequences are out of proportion to the duration. So when you get that shot over the bow, what you're realizing is that you're getting the first mover advantage when the warning is offered. You take immediate action, and it protects you against the follow through consequences of volatility. The herd does not all spook at once. It turns out to be something like lightning strikes, it catches on fire, the fire spreads, and panic spreads. By respecting that first initial shot over the bow, you can protect yourself against all those iterations of emotional selling because you moved first. And then when that run is done, we're not dwelling on that. We're in a position to be able to act on the value opportunity that the end of volatility represents. And so you actually get out sooner. And then, even more importantly, you get back in when the storm has passed. And I think uh, the, the simple rule set that you have, as expressed over those 21 choices, allows you to take advantage of the herd behavior when volatility hits. You're better on the front end, you're better on the back end, and those numbers are decisive in on your chart.
Yeah, thanks, Ken. Thanks. You know, as you were talking, it made me reflect on a connection that I discovered after I had already invented and implemented the shot over the bow rule. I was reading that Investors Business Daily has a very similar gauge of volatility, but they apply it much later in a decline, and they found that the volatility indication that we look at and they look at is actually indicative of further downside, which brings us to the next evolution in this system, and that is using the shot over the bow rule as an opportunity to capture some of the downside by getting short the market. And those are the numbers that we have here. I wonder if you have any reflections on these.
Well, the nice part of this is it shows that by studying the emotions of fear, i.e., volatility, you actually can appreciate the life cycle of typical volatility events. And it turns out that if you are respecting that initial shot over the bow, there's actually enough time to selectively go short and be able to participate in the downside move without getting trapped. It takes some discipline to get in, even more discipline to get out, but there are definite time horizons in which you can effectively trade to the short side. And you're showing right here, you've got almost a 12-15% improvement at no additional risk as measured by drawdown. And a lot of folks will say, well, that's only a 15% improvement. I'm going to say, really? If you don't want 15%, send it to me. 15% is an extraordinary boost to a system that's already performing at a high level. So this just shows you what learning to approach this in chunks and segments really looks like. You don't have to go short. The protection against the short side and the volatility selling is why that BMR 21 works so well. The shot over the bow fine tunes our response to volatility. It makes a dramatic improvement. And then you can go short if you want at certain key times without losing your mind. And this shows the advantage of that layered approach to continuous improvement that we speak about.
Yeah, yeah. And I just go back again to how important that phrase is, continuous improvement. And really for me, when I think about evolving a system, that's really what it comes down to. It's about being on that path of continuous improvement. If
Yeah.
you are, oh, go
Go ahead.
ahead.
I
After
was
you
just going to
finish.
say that return divided by the drawdown, the difference in those systems is just so decisive. I mean, it really shows you what you can achieve if you are focusing on the simple few things that make the biggest difference, being able to
Yeah.
pick the things that matter from among a wide range of choices. This really just shows how that due diligence repays you.
Yeah, absolutely. And I love the return to drawdown metric as a quick and simple way to just get a sense of what is the value of the system. It's basically everyone wants the risk. We all want the risk. We all want the reward. None of us want the risk. And so return to drawdown ratio is a really good way, in my view, of just getting a sense of what is the value add of this system that I'm going to trade or considering trading. So thank you, Ken. I owe you a debt of thanks. These three systems are all evolutions of what I first learned from you back in 2011, the BMR and core first generation systems that you were teaching. They've just those systems alone without even the evolutions, we've got other videos on those and their performance is outstanding too. And then, we just continue to keep improving. So I thank you once again for all of your wisdom and your input and your influence. If you're watching this video and you haven't checked out Dr. Ken Long's work, you can find him at tortoisecapital.net. If you would like more information about any of the versions of the BMR 21 system that we see here, or any of our other monthly systems, all of our second generation systems that have evolved from Ken's systems are available at appliedfinanceresearch.com. Ken, once again, thank you so much. It's just an absolute pleasure. So easy to talk with you. I feel like we could just talk for hours and hours.
Yeah, well, we both got a honeydew list to attend to, so we gotta take care of that business too. So
Indeed.
good to see you. Much love to the family.
Thank you so much, Ken.